Welcome back. You're watching First Trades. We're now going to be touching base with the management of MedPlus. In the second quarter, the numbers certainly impressed the street, and more than that, after that, you've seen upgrades that have come in from brokerage firms like Nomura giving a buy rating and an upside of nearly 54% from the current market price. G Madhukar Reddy, the MD and CEO of MedPlus, now joining us here on the channel. Thank you so much. We wanted to figure out what your prescription for growth is. Numbers were certainly looking healthy at the end of the quarterly results that have been declared. What we've also seen, of course, is that your store expansion and addition is up, 43% year on year, if you were to look at the numbers declared in September. Is this the big strategy going forward, the store expansion, the physical outlets? What can we expect for this financial year and the one going forward?
Absolutely. As we have been saying all along, it's a really big market with very small penetration by the organized retail, and organized retail has got a significant advantage over the independent operators. So the stage is set for us to actually expand, grow, and take advantage of this. And that's what we have been doing. We went to the public to raise money to grow. And in the first year, that was last year, we actually grew by 750 stores. This year, in the first half, we have already grown by 600 stores. The plan is to grow by another 600 odd stores this year. We foresee, a similar kind of growth for the coming years too, given that the market is so large, and it will be, as things stabilize, a very, very profitable market as we go forward.
Can I ask you that the rising competition that is coming in, Jio, NetMeds, apparently there are more than 700 stores now, store-in-store kiosk, Tata 1mg. I think there's number of stores right now are less than 20, but they made no secret about it. They want to be in every pin code. The rising competition, and that we're seeing the conglomerates entry as well. We still don't know the way the Adani's foray into healthcare will be. How will you manage all of this?
Yeah, no, we are aware that some of the leading conglomerates are going to go into the space, and we have known this for a while. As far as I'm concerned, there is enough and more for at least 4 to 5 players out there. It is right now us and Apollo. I fully expect that NetMeds and 1mg will also grow. They'll most likely set up the stores. As I've been saying all along, the market is for the omnichannel guys. It is not, medicines are not something which are easily sold or bought over online, no matter, what overall, let's say, the hoopla has been around that whole thing. Omnichannel is where to go, and all of them have now kind of realized it, and all of them are now setting up stores actively. Even if you see a developed market like US and all, even where there is so much consolidation out there, you still see a CVS, Walgreens, a Rite Aid, and a Do and Read, and a bunch of other local players, not to talk of Walmart also, which has a pretty large pharmacy in its own grocery stores. So I think a country like us can surely take at least 4 to 5 large players. I see no problem with that.
There would be a threshold beyond which pharma retail stores would say, we will not get into this discount war. The NetMeds of the world are getting funded because of PE money. It is like, I'm ordering a milkshake and the PE player is giving me that milkshake at a discount. What do you think would be the turning point at which the entire pharma startup ecosystem would say, we want to do business rather than doling out freebies?
So that phase may be over, actually. NetMed struggled for a long time before getting bought out by Reliance. And I don't think Reliance is really relying on any PE money for that. And I don't think neither is 1mg out there. They're now backed by Tata. If there is any problem, there could be 1 or 2 guys out there, I don't want to take their names at this point of time, who may be having a little bit of an issue with raising money at this point of time. But largely, it is in the hands of, I would say, pretty rational players, be it 1mg or be it Reliance or Apollo or us. They are now, in the mode of getting some customer acquisition kind of thing. They're doing a little bit of promotional discounts, and that is usually for the first 1 or 2 or 3 purchases. But after that, they slip back to the normal 15 to 18% discount, which is completely manageable. We have always been giving a 20% discount and we have been profitable. We intend to, keep it that way. So that's one. And two, what I see is, as I said earlier, there is room for 3 or 4 large players out there, maybe even a couple more after that. All of us will basically bring the advantages of scale to the consumer, and all of these players will take market share from the independent retailers. Independent retailers even today own roughly around 85% of the market. I see no problem with players like us, gaining market share and growing at the cost of these guys over the next few years, mainly because, of the several advantages which we actually give the consumers. Scale definitely has benefit, and that benefits we pass on, and that's what will basically drive our market share.
Moving into...
I think the free lunch, which, BE guys have provided for so long, is probably over, is what I'm thinking right now, at least in the pharmacy retail side.
Why are you moving into the diagnostic business? It's a competitive business. Big diagnostic chains in India today have seen a 50% drop in business. When I speak to some of the pharma companies, they're telling me, look, we own the customer, we're adding another layer of service. But it's a loss-making business. It's a business where margins are not great, and it's a business where the big players are slowing down.
So I would not basically enter into the same business as, let's say, a Dr. Lal's or Metropolis, or even, let's say, someone like what Lupin and Torrent are all entering into that overall sector. So we are a fully integrated radiology/biochemistry and pathology center. We don't have that much competition, actually. The largest players in the country are Vijaya Diagnostic and Krishna, and you don't see too many of these across the country. The margins are still good here. There is room to grow. We are basically getting in because we have a new model, which we think we can actually make real, let's say, inroads with. So yes, while on the face of it, it looks like diagnostics is crowded. What is actually crowded is the, just the biochemistry and pathology side, not the radiology side. The largest guy has probably around 40, 50 MRI machines, that's all. For a country of our size, that is not scale, and there is enough room out there for us to grow.
That's interesting, but I just wanted to delve further with respect to this position in diagnostics, because pricing also has been quite aggressive in pathology and in radiology. So you were confident about margins within diagnostics. Can you just tell us a little bit more about whether or not you're going to replicate that aggressive pricing here?
Absolutely. So you see, for us, what we have seen is, for the longest time, because of the cost involved with setting up a major radiology kind of center, and the overall practice of paying a referral fee to the doctor, the cost of testing was pretty high. That high cost led to underusage. Underusage led to even higher, let's say, lesser scale benefits, as you would say, and that basically increased the cost overall, and that basically just made the whole thing really expensive. What we are doing is basically going in out there, using the MedPlus brand to not pay any referral fee or anything like that to doctors. One, increasing the usage by cutting the cost, which basically drives up the benefits of scale and everything else. So we give a 75% discount on all radiology and all pathology. Our contention is, or not our contention, our thesis, and which has been proven right in the first 2 centers which we launched, fairly large centers, is that the 25% which we actually charge the customer is enough for us to basically make money because of the scale which we have. The subscription money basically is our profit. And we have been extremely successful with the subscription, this thing out there. Last, in the earnings call, we reported a 52,000 membership, this thing out there in our subscription plan. 52,000 plans, accounting for roughly around 90,000 lives, each of them paying around 1,300 or so, which will form the backbone of the entire business plan for us, the increasing subscription of members.
All right. And just if you could walk us through, given the fact that you're very ambitious with your store expansion plans, how you're looking at profitabilities of these new stores and when you can break even?
Okay, no. So for us, we are making money as a company on the overall this thing. The new stores are a little bit of drag. We have 1,000 stores which are less than a year, and something like 49% of our stores are less than 2 years. Just to give you a little bit of the background, typically 40 to 50% of our stores break even in 3 months, 75% of our stores break even in 6 months. And after that, they go to an EBITDA of around 10% within 2 years. So in that phase, which is 0 to 24, they are a drag on the overall EBITDA. They're not really making loss after the first 6 months, but they're not really contributing to the EBITDA at the level of the mature stores. Given that 50% of our network is really young right now, the overall EBITDA looks a little less. But for stores which are more than 24 months, it is business as usual. We are, at 10.4 to 10.5% EBITDA. And even for the new ones, they are going along the trajectory we expected they would. To answer your question, we're already profitable. We'll become more profitable as the number of stores which we have become a lesser percentage of the base of stores. For instance, this year we're adding 1,200 stores on 2,700 or 2,750 stores. Next year, we'll probably add a similar number on a 4,000 store base. And so the effect of the new stores is going to continually come down. That's one. So the drag will be less. And meanwhile, we continue to grow the private label, which actually adds to our margin. So our gross profit margin actually continues to grow. And that will also, help in increasing the margins out there.
Okay, and the stock higher today by nearly 2%. Thank you so much for being live with us on the show today to take us, through the market dynamics and the market construct as well, the way the competition is, how you are fighting it, whether we should all be getting used to the deep discounting as well. That has certainly been the case too.